Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. We have seen Verizon stock continue to fall throughout 2023, and there are a number of reasons that investors are concerned about the company. One of the biggest has to do with rising interest rates. This has a couple of effects on Verizon stock. One, when interest rates go up for bonds, especially US government bonds, that's considered a risk-free investment. So if you can get 5% risk-free returns for 5 to 10 years from buying bonds, why would you go out and take more risk to buy a company like Verizon, which may cut its dividend in the future? It isn't a stable payout the way that a US government bond is. So the comparison between government bond yields and stock dividend yields really impacts yields and also stock prices as a result. The other thing is that Verizon has a lot of debt. As I'm recording, $2 billion worth of debt, according to Koyfin, and some of that debt is going to need to be refinanced. When it's refinanced, it's going to go from the low interest rates that we've seen over the last 10 or 15 years to now elevated interest rates because it's going to be more market priced interest rates. So put all of this together and you have a very complicated debt situation for Verizon. So I want to go through some of the numbers today, what we know about the company's debt situation and what to expect in the future. Because I think we are going to see Verizon change some of its strategy with what it's doing with its cash. Maybe it doesn't increase dividends as much in the future. It chooses to use some of that money to pay down debt, which we've seen a little bit of in the past. So let's get into the numbers. Before we do, my name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. Check out fool.com/ASYM. I have a link on the screen here and then a link in the show notes for their top 10 stocks to buy right now. The first thing I want to do is show some of Verizon's operating metrics to show kind of where the cash is coming from and where it's going. This is from Verizon's most recent quarterly presentation. This is for first half of 2023 results. You can see that cash flow from operations, $18 billion. That's up slightly from a year ago, so moving in the right direction. Capital expenditures were $10.1 billion, coming down. And if you look at the quarterly numbers, actually coming down pretty rapidly. Free cash flow, $8 billion. And like I said, the reduction in capital expenditures actually means that Verizon is on a run rate for over $10 billion a year in free cash flow. It is actually on more like a run rate basis of $20 billion or more in free cash flow. Dividends paid, $5.5 billion. So this is where a lot of the cash is going. This is the 8.4% dividend yield is really hamstringing the company's ability to do things like pay down debt because investors expect that dividend to be paid quarter after quarter, year after year. And then you get to the total debt. This is the biggest problem for Verizon right now. $152.7 billion worth of debt, offset only slightly by $4.8 billion worth of cash. So let's get into what kind of debt that is, how much of that is fixed rate, how much is going to be maturing very soon, how much is variable rate. This is a complete look at Verizon's debt. It doesn't have every single debt item in here. It's actually combined it into different maturities and gives some interest rates. There are huge tables that show exactly what debt Verizon has and where it's located in the world. So very complicated debt structure, but this kind of simplifies it into something that's easier to read. And this is as of the end of 2022. So a couple of things to keep in mind here. Maturity is less than 5 years, and there's going to be this line item here and then another line item down here for asset-backed debt. $1 billion is the first number, $10 billion is the second, so $34 billion of debt coming due in the next 5 years. Most of that is going to be relatively low interest rates. The highest interest rate we see is 5.82%, and the interest rates go as low as 0.75%. So very low interest rates that Verizon has locked up for the next 5 years or so. This is the debt that you want to be worried about as an investor, because if that interest rate goes from 1% to 7, 8, 9%, that's a huge increase in cost. Each percentage point increase in this $34 billion worth of debt would be another $340 million of interest expense for Verizon. So very costly if it's going to go up 4, 5, 6%. The other thing to keep in mind is that there is variable term debt. And this is where we want to keep an eye on this floating interest rate debt. This is usually tied to LIBOR, and some of this debt is due in the next 5 years. Some of it is due in 5 to 10 years, but that debt is going to adjust to a higher interest rate. So, about $6 billion worth of debt that is going to, over time, see interest rates rise along with what the prevailing rate is for the market that the company is in. There's also asset backed debt that is floating, about $10.3 billion in worth of debt there. That's this line item here. So, a core concern for Verizon is not only do they have $150 billion worth of debt, but they have debt that is going to be rising in costs over not just the next few months, but the next few years. So there are two things to watch when it comes to Verizon's debt levels. One is, how does operating cash flow and free cash flow from the business improve over time? So are they getting leverage from the investments, particularly in the 5G network that they put in over the last few years? That's where a lot of the spending has come from, is both buying spectrum and then building out that 5G network. We need to start to see a return on investment. Actually, the demands for the return on investment have gone up in just the last few years as interest rates have risen. So are we going to start to see that cash flow improve? I want to pull up another table here, and this is the metrics that management gave in the most recent quarter about cash flow and guidance or forecast for the year. So this is a little bit small, but on the bottom here, this number I'm highlighting in blue, you can see that in the most recent 3 months, cash flow has been $5.6 billion. I mentioned earlier that for the first 6 months of the year, cash flow is $8 billion. So you can see that that's increasing pretty significantly quarter over quarter. For the full year, management expects about $17 billion in free cash flow. That's right here. And that is because capital expenditures are going down from a rate of over $20 billion per year to right around $18 to $19 billion. And that's going to come down to about $17 billion, I believe is the number next year. So the cash flow number should improve as all of these things play out. Now, what we do need to see is continued operational improvement. So customers continuing to add fixed wireless, Verizon getting more customers from both the business side, where it's actually done pretty well, as well as the customer side, because if that revenue goes up, this is actually a very high margin business for wireless services. So that's what you want to see grow. And if free cash flow continues to grow, then that debt level of $150 billion is not actually that big of a deal, especially if you start to pay it down. But this is from the operational side, what investors are going to want to keep an eye on. From there, we want to see what does Verizon actually do with that free cash flow. $17 billion in cash flow, using about $10 billion of that to pay investors a dividend. Now, I would argue that it would be more prudent to actually cut the dividend and pay off debt really rapidly as they can, especially given those rising interest rates. But that's not something that companies typically do, because if Verizon announced that they're going to eliminate their dividend tomorrow, the stock would tank. There's a lot of investors that own the stock just simply for the dividend. So that's the reason that that's not going to happen. But I do think that we are already starting to see Verizon start to pay down some of their debt and get more aggressive doing that, trying to generate more cash flow from the business. They're raising prices. And if they can continue to pay down that debt just by a few $1 billion per quarter, that's going to be an incremental positive to reduce leverage in the business. Add all of this together, and it's a very complicated debt structure for Verizon. There's a lot of leverage in the business, therefore a lot of risk. That's one of the reasons that the stock is down as much as it is in 2023. The good news for investors is that you get a high dividend yield of 8.4%. The downside is that cash flow is relatively high risk, given what we have seen from the business and from rising interest rates over the past 6 months to a year. So a lot to keep an eye on. But my take on this right now is the risk reward is positive enough given the cash flow that Verizon has from its business overall. I'm not saying that the dividend yield is going to be safe. So if you're just buying the stock for an 8% dividend yield, that may not be a good strategy long term. But if they pay down that debt and use that cash flow that is coming into the business to de-lever the business and get down to a lower dividend yield, I think that would actually be a great use of cash and give more flexibility for growth in the future. But what do you think about Verizon, where they're sitting today, and the amount of debt, $34 billion, that they're going to have coming due in the next 5 years? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.